Hello, and welcome back to Armbruster Capital Management's InvestEd VidCast series. I'm Mark Armbruster, and I'm here today with John Lyon. John's been working in the investment business for the past 10 years. He's been focusing on quantitative research and analysis. He's also been a friend of our firm for many years, and I'm very pleased to have him with us here today. As a quant, John has a background in factor-based investing. That's a strategy that we've been using here at Armbruster Capital Management for many years. And John recently did a study using factor-based analysis that we thought was interesting. So, John, can you tell us a little bit about the work that you did?
Sure. It was a multi-factor analysis of an exchange-traded fund called the ARK Innovation ETF. The ticker symbol is ARKK, if anyone has any interest in looking it up.
And what drew you to this fund? Why did you decide to explore it?
Sure. So like many investors, I was and have been pretty captivated by the run of some of the really high growth names in the market. I was really sort of interested in the fund for a couple of reasons. One, they own a lot of these really high growth type of names that have done really well this year. And second, the fund really has kind of a unique branding around it. So the woman who founded, Cathie Wood, is pretty high profile and has put out some really wild price targets on some of these names. I think right now she has a $6,000 price target on Tesla. And she has a reputation for hiring people with kind of a non-investment background to be analysts at her firm. So not necessarily people who would have worked on Wall Street, but people who have background in the specific industries where they invest. And so those things caught my attention. And then the returns have been really sort of out of this world this year and certainly eye-popping. So that led me to explore it a little bit more.
So let's talk about the returns a little bit. Have they been great this year? Have they been great historically? Have they been consistent through time? You know, what did you find when you looked at the return history?
So they've been pretty uneven over time. They've had a few flat years over the last few years. So 2015, 2016, and 2018 were all sort of flattish for them. But 2017, 2019, and 2020 were really, again, out of the park. So 2017, they were up around, I think, 80%. And then 2019, they were up around 35, 40%, which is pretty similar to what the market returned. And then this year, they've been really dramatic. As of today, I believe they're up about 100% for the year. So they have been kind of all over the place and certainly volatile.
Do you think that the fund at a much bigger size can continue to generate the types of returns that they've enjoyed in the past?
Yeah, so they have really dramatically increased their assets under management, particularly over the last year. So their AUM has gone from about 1.6 billion as of August 2019 to about 8.4 billion as of August 2020, which was sort of the measurement period that I looked at. And as of right now, they're just a shade under 10 billion. So they have seen this really dramatic increase in their assets under management. So, they end up being these really large shareholders of these companies that they own. So it could end up being a situation where they do have a little bit less liquidity. And they're also very concentrated in their portfolio as well.
Yeah, let's talk about that concentration. Is it concentration within industries or within stocks or all of the above?
It's all of the above. So a lot of their performance sort of at first passes come from owning a few really high growth names that have really done well this year. So about 11% of their fund is in one name, which is Tesla. And then about 50% of their fund is in the top 10 names. So it's certainly very concentrated. And this is especially as ETFs go. ETFs tend to be passive, very diversified, and they own just a few names in an ETF structure. So that's pretty unusual. They're also very concentrated from a sector perspective. Most of their stocks that they own fall into one of four sectors, which would be consumer discretionary. So you think of Tesla as falling into that area, healthcare, and really they own biotechnology names within healthcare. They own less of the traditional healthcare names that you would think of, technology and communication. So those are traditionally very growth-oriented sectors, or the sectors that have been sort of the highest octane this year. And so they're very much concentrated in those areas.
Talk a little bit about the analysis that you did, the factor analysis. Maybe explain to us what factor what factor analysis is, and then how did you apply it to this fund?
One of the things that was interesting was, I saw the returns that were so dramatic and outperformed the market by so much over the past few years, and so I was really curious to know whether or not that came from sort of this non-traditional approach that they've taken to investing, or if it was something that could be explained by more traditional risk factors. So the analysis I did looked at a set of stock selection factors which can explain the risk and return of stocks over a long period of time. And so I regressed the returns of the ETF and regressed against these different stock selection factors. And what I found is that a large percentage of their returns are explained by a few factors, and explained to a really great extent by a few factors. So they have loaded up on risk to the market, so they tend to be high beta, high volatility names. They've invested in very expensive stocks, in contrast to value stocks, and they invest in stocks that tend to invest really aggressively over time. So they've really kind of loaded up on these risk factors. And if you look at those bets over a long period of time, they kind of represent the opposite of what you would normally want to do as an investor. So risky, expensive, aggressive investors tend to be poor performers over a long period of time. And they've sort of loaded up on these areas. And it just happens to be a period over the last 5 to 6 years where those risk factors have experienced unusually good performance relative to the traditionally bad performance that they experience. Value stocks have had a long period of underperformance. Stocks that invest very aggressively in growth have attained a really high multiple. And then because it's been an above average period for the stock market in general, a fund that has a high beta or a high exposure to market risk has really paid off. So they've really kind of hit the lottery on these risk factors that traditionally, having exposure the way they do wouldn't have done very well. And the other thing I would point out too about the findings is that if you look at the intercept of this type of regression, the intercept in the regression represents the alpha, or the excess value that the manager generates that can't be explained by a traditional systematic risk factor. And if you look at that number, it's not statistically significant in the regression, meaning that none of their performance represents skill, essentially, on the part of the manager. It's something where they have achieved these outsized returns purely by loading up on these risk bets, and not through some sort of unique approach to investing, is kind of the way they've marketed it.
So it's really more being in the right place at the right time. You're saying that this strategy is the antithesis of, maybe a Warren Buffett approach, or approaches that have worked over the long term in the past. Buying good stocks at cheap prices. This is the opposite of that. They're buying
Exactly.
They may be good companies, but they're paying high prices for them. So how does that end ultimately? Do you think that can continue, or do you think that ultimately investors are looking for future disappointment here?
Well, it's always hard to know when something like this will end, and when you're in the midst of a market environment like this, it's really hard to know where the endpoint will be, and it's really hard to see sort of the light at the end of the tunnel, if you will. But if you use other periods as analogs, you can kind of see that eventually this type of investment style doesn't end well.
Do you think that this is sort of like the tech boom of the 1990s, where investors are overvaluing growth in the markets, and sort of throwing caution to the wind as far as those long-term, tenets of investing are concerned?
I think it's very similar. And I think there's a similar psychology that goes into that type of investing that is very present here. And so, I think it immediately starts out with, this area of new growth being sort of unusual, and investors start to sort of dip into those areas, and then slowly they go up and become larger portions of the market. And at some point, they become areas where large institutions can't really ignore, and they have to invest after a while. And so it creates this sort of idea of fear of missing out, where if you see other managers owning these names and outperforming, then and you're underperforming and you're losing assets, losing clients, then you say, well, I should probably be in these names as well. So I think it's very similar to that type of psychology that we saw in the late 1990s that drove the tech bubble.
That's a really interesting point, John, that usually when you think about emotional decisions or behavioral reactions, or fear of missing out, people tend to talk about individual investors, or Robinhood investors, or something like that. You're actually saying that's pervasive throughout the investing world, and maybe more so with professional investors because of the career risk that they face.
Yeah, absolutely. I think it's potentially more pervasive within institutional investors, and it's certainly more impactful on the markets. When you get names as large as Tesla making these types of giant moves day to day, it has to be institutional investors that are driving it rather than individual investors. Individual investors just don't have enough money at play in the market to drive stock prices like that. So it's certainly institutions that are making those decisions. And a lot of it eventually ends up being driven by FOMO, by fear of missing out. They see other people doing well and performing well, and these names are becoming such large parts of their benchmarks that they say, well, we have to end up owning these names. And so initially, while those the jump into those names might have been driven by some sort of economic impact, in this case, growth names have been pretty scarce for the last 10 years. We've had a really slow economic recovery. It's the slowest economic recovery since World War II. And as a result, there were only a few companies, large tech companies, and tech-related names that were growing really quickly. So people felt they had to jump into those names. And as people jump into those names, you saw the stock prices go up, sell-side analysts raise their price targets, and then the stock prices go up more. They become larger parts of the benchmark. And investors who might have been out of them otherwise are saying, well, we just have to own these names now because there's just too much risk in deviating from the benchmark by such a wide margin. So they pile into the names go up even more. And so eventually you have these prices that are being driven not by underlying fundamentals or the value of the business, but they're driven by market sentiment and psychology and the need to sort of preserve your career and keep money from going out the door. And you saw this in the 1990s, really specifically. The two largest hedge funds in the late 1990s were Tiger Management, which was run by Julian Robertson, and the Quantum Fund, which was run by George Soros and Stanley Druckenmiller. Both of those funds closed down in early 2000. Tiger was very value-oriented in their approach, and they shut down because value had underperformed so dramatically, and they felt like they just couldn't compete and add value the way the market was behaving. And then Quantum Fund shut down sort of for the opposite reason, in that they tried to ride out the bubble and tried to own some of the tech names and kind of had their face ripped off in the early part of 2000. If they both had just waited 6 months, they would have been on the other side of the trade and it would have been good. So this is a really real career risk that managers face, and it's not hypothetical, and even the largest of funds can be impacted by it. So certainly institutions are susceptible to it just as much as individuals, and in many cases they have less opportunity to be patient and long-term oriented, so they make these decisions more dramatically and with more capital than individuals can make them.
That's an interesting point. There was just an announcement that AJO, Ted Aronson's firm, which is a big value shop, been around since the 1980s, they just threw in the towel and decided to close down. You are seeing some shifting in the market right now. On a lot of days, value is starting to outperform and technology is faltering a little bit. Do you think some of those signs of a market top are finally playing out? Do you think we're getting close to a turning point where funds like ARK won't do so well anymore?
It's really hard to know when the music will stop, so to speak. And it was really hard to know in the late 90s. I mean, there were market analysts and prognosticators who said that things would end in 1996. In 1996, they said, we're getting out of the market. The market's just too overdone. And of course, you had another 3 years after that where the market just continued to move higher and higher. And so it's really hard to know exactly when these things will turn around. And, I've talked to a few value managers in the business, and they've kind of expressed this frustration that you'll see these moves for a few weeks or a couple of months in value names where value has this rally, and think, okay, this is it. This is the rotation has happened. And then there'll be some new announcement in one of the high growth names. Tesla stock will split, or they'll join the S&P 500, or there'll be some sort of great earnings announcement for Zoom or something like that will happen, and the growth rally will resume once again. So it's really hard to know exactly when it's going to play out. But I think the thing to remember with this is that there isn't necessarily going to be one catalyst for a top in the growth rally or the growth bubble, if you want to call it that. If stock prices are driven up by irrationality, they can also be driven down by irrationality. I mean, there was no one macroeconomic event or policy change that caused the top of the NASDAQ, when it did in early 2000. It just happened that day. And then it started declining that day for no reason other than the last buyer, the greatest fool, so to speak, had gotten in. And that was it. That just happened to be the day. And nobody knew that was the day until after it happened. And you saw even 9 months after it happened, at the beginning of 2001, a lot of sell-side analysts were polled as saying, yeah, this will be a great year for technology stocks. Like we've had this, this 9 to 10 month sell-off in tech names, and the growth story is still there. And this is going to be maybe the best year ever for tech names. And of course, 2001 was even worse, way worse than 2000 was. So you never know. You never know exactly when it's going to happen. It certainly seems like we're closer to the end than the beginning of it, but you don't know for sure.
Yeah. So sentiment drives it up. Sentiment can drive it down. Besides, so let's say you do subscribe to this approach where long-term drivers of returns be damned. I want to get on the gravy train. I want a high beta, large cap growth strategy. It's 75 basis points. Is the ARK Innovation Fund the way to play this strategy?
No, probably not, because we've seen that their returns can be replicated by systematic factors, and those are available really cheaply. And so you can buy index funds that replicate that performance for almost nothing. So to pay 75 basis points for a fund that doesn't add any alpha and simply loads up on these risk factors, you could accomplish that through leverage or through owning ETFs. So it doesn't really make sense to play it through this fund.
So there have been periods in the past where this type of approach worked. This high growth, large cap type of approach was beneficial. You mentioned the 1990s. It was also true in the early 1970s. How do those periods typically end, though? Are people able to get out in time, or does it ultimately end in tears?
Sure. So both of those periods were really similar. We've talked a little bit about the late 1990s, and that was very similar. In the way that the stock prices behaved and the way institutional investors behaved towards tech names. And it was very similar in the early 70s as well, where you had this group of stocks called the Nifty 50 that were, again, high quality companies, well-known names, made products and services that everybody knew about and used, but they were trading at these really exorbitant multiples. And the thought there was good at any price. You should own this name at any price. If the PE is 25, own it. If the PE is 50, own it. If it's 100, own it. It's just such a good company, you have to own it. And in both cases, you saw a really big decline on the other side of this sort of mania. And, I think that there's a good chance that, if you do sort of load up on these types of names, you run the risk of these things going down, by quite a bit, and selling off quite a bit. It's not necessarily going to be the entire market, because right now you notice that only a few names are fit this profile of being really large, really expensive, and really growing quickly and investing aggressively. So it's not necessarily going to be the whole market, but if you do kind of load up on these risks that a fund like the ARK Innovation ETF is loaded up on, you run the risk of a similar thing playing out, or a similar event playing out as played out in the early 70s or the late 1990s.
So are you a buyer of the fund at this level?
I'm not a buyer of the fund at this level. No, I think that should be relatively clear. I think it's too expensive. I think they own names that are certainly overdone. They're so early stage. They're so high growth and high volatile that just a little tweak in the valuation, or just a little tweak in the investor psychology that's driving the names can create a big down move. So it's hard to invest really from a risk standpoint. It's not necessarily something where you want to think about how are these companies going to do, but what's the risk of owning them at the level where they are now.
Thank you, John. That's really helpful. That's very insightful. I want to thank you for joining us today, and I want to say thank you to our listeners for tuning in to this issue of our InvestEd VidCast series. As always, if you have questions or would like to talk about this or any investment topic in more detail, feel free to reach out anytime.
Thanks, Mark.